Hi guys, welcome to Compounding Everything. My name's Chris, and this is the channel that discusses all things investing, finance, and business. If you haven't already, click that little subscribe button and the bell next to it. It'll keep you up to date on all of our future content that we're going to be bringing out, helping you grow a long-term successful investment portfolio. In this video, guys, we're going to be talking about Australia's largest low-cost index funds, why Warren Buffett himself thinks that you should buy them, and more. Stick around. Now, for those that already know what a low-cost index fund is, feel free to use the timestamps in the description below and skip ahead. However, if you're a new investor, please stick around for the next 30 seconds because I'll break down what an index fund is and how it can help you. So, maybe you're new to investing or you just haven't looked at index funds before. But what an index fund is a collection of securities, aka stocks, that represent a specific portion of any given market around the world. A real-world example of this would be, say, the S&P 500. The S&P 500 represents the largest 500 companies listed on the New York Stock Exchange. So what happens is that companies like Vanguard and BlackRock created funds, and within those funds purchased a small piece of each of those 500 companies making up the S&P 500. What that does is allow you to buy one single share, and within that single share of this fund, you will own a small piece of every single one of those 500 companies. The benefit to something like this would be the hassle of buying obviously one share and not having to maintain 500 different purchases, which is probably nearly impossible over the long term. Now, of course, this can be a convenient tool for those wanting to have unrestricted exposure while diversifying their portfolio. Which leads me back to the low-cost part of my original point. All exchange-traded funds have a set management fee that is due each year and deducted from the balance of your investment at the time. This amount can vary greatly and is normally found on each individual fund's PDS. However, in this video, we would generally speaking be considering any fund under 0.35% or 1/3% a low-cost fund. If you're new to investing, why don't you comment below and tell me how much of your portfolio is dedicated to index funds currently. So now we've kind of cliff noted our way through what an index fund is. Let's talk about the two most popular low-cost index funds in Australia and then a couple of my personal favorites. To kick things off, we're going to start with the iShares S&P 500 EFT. Now, this is essentially the Aussie's ticket to the S&P 500. The fund aims to provide Aussie investors with the performance of the S&P 500 index before fees and expenses. So essentially, this index is designed to measure the performance of the largest 500 companies in the United States on the New York Stock Exchange. Before we get into what I absolutely love about this fund, are there any negatives that you as an investor might want to consider? Well, my main concern with this fund right now would be probably the Australian dollar or lack thereof. Having seen almost record lows over the last couple of months, this can take a toll on possible returns if the dollar were to become really strong really fast. In saying that, there is a hedged option from BlackRock called IHVV. So what are the main reasons that I personally love IVV and why I think it should definitely be a fund that you consider? First of all, it's Australia's ticket to the largest 500 companies listed in the US. That in itself is a very important tool for investors that are wanting long-term broad exposure to index funds like these. The second one, it's extremely low cost. With a management fee of 0.04%, I think that it actually, and please correct me if I'm wrong, might be the lowest cost index fund listed on the ASX. I'm not sure actually if even this is a lower cost index fund than the Big Brother version that is actually based on the US market, which I believe might be just over 0.04%, but I'm not too sure on that, so please feel free to correct me in the comments. I guess the third point here would be you can use this fund to diversify internationally as an Australian and seek long-term growth opportunities that you really couldn't obtain anywhere else if you're entering a position like this, say via dollar cost averaging. And finally, the most critical point of all, in my opinion, over the last 100 years, this fund, the S&P 500, has returned a massive 9% annually. Just think about that. every significant event in your life, your parents' lives, and their parents' lives is also taken into account within that 9% return over the last 100 years. It's an incredible return that is almost unprecedented over that period of time. In fact, you probably can't find any fund that has returned 9% over a 100 plus year period. And the cool thing is that it doesn't stop at 100 years. You can actually go back further and see those types of returns. We all know that there are no guarantees in this game. But man, this index fund has to be about as close as possible to one. And I personally like to be on the side of history if you're trying to gain a long-term advantage over a 30 or 40 year period in the market. So in saying that, does this fund have a place in your portfolio as an Australian? The short answer is probably yes. A fund like this is literally what Warren Buffett is talking about when he quotes, "The average investor is better off investing in a low-cost index fund over a long period of time." This is it. This is that fund that he is referencing. I have included a link below that will give you more information on IVV. You can read the PDS, you can look at all the management fees and details, and you can actually see the exact holdings of what's inside of that fund percentage-wise. The next fund, which does actually hold a position in my own personal portfolio, is the Vanguard Australian Shares Index EFT, tracking the largest 300 listed companies on the Australian Securities Exchange in Australia. According to Vanguard themselves, this fund suits buy and hold investors seeking long-term capital growth, some tax-effective income, and a higher tolerance for the risks associated with general share market volatility. This fund does fit right into our low-cost category with a very reasonable 0.1% management fee. So I guess, what are the downsides of purchasing a fund like this? Well, firstly, the Aussie market, especially the top 300 securities, are generally speaking dividend heavy. This can have an impact on capital gains, so perhaps a fund like this might not be best suited to a more aggressive type investor. It also might not be suited to somebody that is a younger person because it may affect your taxable income. So that is definitely something to think about. If you're worried about lowering your taxable income every year, you might want to consider having a fund that is more focused on capital gains over income itself. In saying that, what do I like about this fund? Well, firstly, the consistency it can provide for new investors and retirees alike, paying a consistent distribution of roughly 4 to 5% annually, along with some capital gains. Since inception, this fund has actually achieved a 6.83% annual growth rate, which is not to be snarled at all. And like I said earlier, another benefit to a fund like this would be its incredibly low management cost. Most Aussies are paying 1% plus cost in their fees via superannuation fund every year. Over 30 to 40 years, this can really add up, as you can see here. The difference over a 30-year period between 0.1% and 1% is mind-blowing and might make you reconsider how vital it can be taking management fees into account. Now, like I said, VAS does hold a reasonable percentage of my portfolio currently, and the main reason for that is simply because of its bread and butter return that it has provided over years and years and years for investors just like us. So I do plan on increasing my percentage, or the percentage of my portfolio that holds VAS over the next 10 to 15 years, and it definitely will be a part of my long-term strategy. So it might be something that you want to consider talking to your financial advisor about. Once again, I will leave a link below with some more information and a link to the PDS. Feel free to check it out. Before we wrap things up, I thought I'd also mention some other more specific funds that you might be interested in. Keep in mind, these funds are not necessarily classed as low cost. Generally speaking, the more complex a fund is, the higher the management fee will end up being, but they are nonetheless some pretty interesting funds. The first of these funds is the Vanguard MSCI Index International Shares EFT. VGS is its ticker code. Now, this fund provides exposure to approximately 1,500 large and mid-cap companies listed on the exchanges of the world's largest economies, excluding Australia. So it's a bit odd, but what they've done here is essentially say, look, As an Australian investor, you probably might already have an index fund covering the largest X amount of companies locally. So what we've done is we've created a fund for you that will cover 1,500 of the largest cap companies around the world in one neat package. That's what this fund is. So once again, VGS will be linked in the description below. The next fund is a proven long-term winner in itself. Vanguard US Total Market Share Index EFT, VTS, is an exchange-traded fund seeking to provide investment results that correspond to the price and yield performance of the CRSP US Total Market Index. That was a mouthful, so what does it actually mean? Well, it's an index fund that covers the entire US stock market, literally. So if you want a little piece of every listed company in America, here's your ticket. Another interesting fund is the iShares Global 100 EFT, or IOO. This is a fund that's tracking the largest 100 companies globally. It doesn't matter what stock market they're listed on. This is tracking the largest 100 companies in the world, meaning that you'll own a small percentage of the top 100 companies listed in the world, which is, I guess, kind of cool, right? The next one will be for those that want some exposure to property locally here in Australia. This fund comes by the name of Vanguard Australian Property Security Index, EFT, or VAP. It provides investors with the opportunity to invest in a portfolio of real estate investment trust, REITs, across the retail, office, industrial, tourism, and infrastructure sectors. Funds like this are generally speaking reasonable performers in the sense of income and slight capital growth over a long period of time. Speaking of income, this final fund is built to provide you with a recurring income on your invested capital. The Vanguard Australian Shares High Yield EFT, or VHY, provides low-cost exposure to companies listed on the ASX that have higher forecasted dividends relative to that of other ASX listed companies. Essentially, the goal of this fund is to provide you with an above average dividend payment, generally speaking, roughly around 5% per annum. So look, there are literally hundreds of these funds covering all kinds of weird and wonderful asset classes on the ASX. I'm going to leave a link below in the description for what I believe is probably the single best collection of index fund information for Aussie investors. Feel free to check it out. I mean, it is dense, but you'll find some handy information in there. Don't forget to smash that like button. It helps taming the beast that is the YouTube algorithm. And of course, if you haven't already, press that subscribe button so you can learn more about investing and building a long-term successful portfolio. So that brings me to the end of this video. Thanks again for watching. I appreciate you, and I'll catch you next time. Cheers, guys.